What if your money could grow in chaos? While the world burns with wars, inflation, and collapsing banks, 12 companies are quietly paying investors every quarter. Rain or shine, they cut checks. Welcome to the world of resilient dividend giants. And before we reveal the secrets of recession-proof investing, this video is sponsored by Preply. Whether you're aiming to sharpen your financial vocabulary, learn the language of global markets, or negotiate your next deal in Mandarin, Preply connects you to expert tutors worldwide. Link in description. Learn smarter. Grow faster. In today's volatile market, dividend-paying stocks are more than income machines. They're financial fortresses. In this deep dive, we unveil 12 powerhouse companies that have not only survived multiple global crises, but rewarded their investors every step of the way. These aren't speculative plays. These are dividend kings and aristocrats that have endured the dot-com bubble, the 2008 crash, COVID-19, and now war in Europe and trade wars with China. This isn't hype. This is your crisis playbook. Part 1. Why dividends matter in chaos. When markets crumble, speculation dies. But cash flow? That's king. Dividend stocks offer passive income during downturns, psychological stability when everything else plummets, and signals of financial strength because only healthy companies pay out. During the 2008 financial crisis, investors who held dividend stocks suffered less volatility and recovered faster. During COVID, strong dividend payers in healthcare and utilities surged while tech stocks rollercoaster. The key? Resilience. And that's exactly what we've analyzed in these 12 stocks. Part 2. How we selected these stocks. To make this list, each stock had to operate in a defensive sector like healthcare, consumer staples, or utilities. We looked for a minimum of 20 years of dividend history, steady growth through crises, strong free cash flow, and ideally, inclusion in the elite dividend aristocrats or dividend kings lists. These companies aren't just safe. They're designed to thrive when the rest of the market panics. Part 3. The 12 recession-resistant dividend stocks. Let's dive into the titans of dividend resilience. We begin with Procter & Gamble. This consumer goods giant has delivered dividend growth for an astonishing 69 consecutive years. With brands like Tide, Gillette, and Pampers found in homes around the globe, P&G thrives on consistent, inelastic demand. Its payout ratio hovers around 60%, showing a disciplined balance between shareholder returns and business reinvestment. Next, we have Coca-Cola. With a 61-year track record of raising dividends, Coca-Cola stands tall in the beverage industry. Its worldwide brand recognition, deep distribution channels, and pricing power allow it to maintain a dividend yield of nearly 3% even during global turmoil. Then there's Johnson & Johnson, a healthcare titan that has increased its dividend for 63 consecutive years. With a business spanning pharmaceuticals, medical devices, and consumer health products, J&J enjoys stable, diversified revenue streams. Healthcare is largely recession-proof, and Johnson & Johnson is a prime example of that resilience. Our utility pick, Consolidated Edison, brings 51 years of dividend growth to the table. Based in the heart of New York City, this regulated utility delivers electricity, gas, and steam services. Its revenue is as predictable as its infrastructure is essential, leading to a steady dividend yield of about 3.15%. When it comes to defense, Lockheed Martin is unmatched. For 22 years, this aerospace and defense leader has grown its dividend. With long-term government contracts and increasing defense budgets during global instability, Lockheed offers consistent returns and a yield close to 3%. PepsiCo is next on our radar. With 53 years of consecutive dividend increases, PepsiCo benefits from a diversified product line that includes beverages, snacks, and food items. Its recession-resistant brands, like Frito-Lay and Quaker, support a generous dividend yield of around 3.7%. Colgate-Palmolive also makes the list, having rewarded shareholders for 61 straight years. Specializing in essential household and personal care products, Colgate's global presence and strong brand recognition offer consistency even during downturns. Kimberly-Clark joins the group with 53 years of dividend growth. Known for products like Kleenex and Huggies, Kimberly-Clark serves essential needs across multiple demographics. Its steady cash flow makes it a reliable performer in volatile markets. Hormel Foods brings 58 years of increases, proving that even food processors can be defensive powerhouses. With familiar brands like Spam and Skippy, Hormel meets consistent consumer demand and thrives in both boom and bust cycles. Another food sector stalwart, J.M. Smucker, has grown dividends for 28 years. Known for Folgers coffee and Jif peanut butter, Smucker combines brand loyalty with operational discipline. With a payout ratio under 50% and a yield close to 4%, it's a rock-solid income stock. AbbVie offers something different. Although a relatively new spin-off from Abbott Labs, it has delivered dividend growth for 11 consecutive years. With a pharmaceutical focus and blockbuster drugs like Humira, AbbVie maintains a high yield, but also requires monitoring due to its elevated payout ratio. Finally, we round things off with NextEra Energy. With 31 years of rising dividends, this Florida-based utility is also a global leader in renewable energy. Its dual model, regulated utility and clean energy innovation, provides both current yield and future upside. Part 4. Sector Snapshot. Looking across these companies, some patterns emerge. Consumer staples dominate, from food to hygiene to beverages. Essentials that never go out of style. Healthcare companies hold strong regardless of the economy, while utilities provide the most consistent income of all. Lockheed Martin adds a layer of defense protection, quite literally, in the age of geopolitical risk. These sectors don't just survive, they persist and pay, even when the world is in turmoil. Part 5. Tactics to build your crisis-proof portfolio. Now that you know the players, let's talk strategy. Pick a handful, 3 to 5 companies, from different sectors to diversify risk. Reinvest your dividends using DRIP strategies to harness compounding over time. Focus on those with lower payout ratios for better sustainability, and always monitor macroeconomic themes like inflation, interest rates, and supply chains to position yourself ahead of the curve. This is how smart money plays defense and offense at the same time. We live in a world that chases shiny objects, memes, hype stocks, overnight millionaires. But real wealth? It's built quietly, over time, on the back of companies that do one simple thing consistently: pay. These 12 dividend giants aren't just symbols of stability, they're active engines of wealth generation. In the face of inflation, recession, and geopolitical upheaval, they keep delivering, not promises, but profits. They are the bedrock for anyone serious about building generational wealth. So, here's the big question. Are you going to gamble on speculation? Or are you ready to anchor your portfolio in strength? And speaking of building, pre-ply learners understand that investing isn't just about dollars, it's about knowledge. Whether you want to understand the language of Wall Street, the nuances of global markets, or simply become a sharper, more strategic thinker, pre-play is where learners become leaders. Find your edge, click the link in the description, and level up today. If you found value in this video, give it a like, hit subscribe, and drop your favorite dividend stock in the comments. Let's keep this conversation growing. And remember, in chaos, cash flow isn't just king, it's your lifeline.